For May, jobs growth increased by 172,000, continuing the solid expansion. Look at the chart at the right. The trend is quite decent with no major drop. For leisure and hospitality, this time around, they let the jobs gain at 70,000, but it could be because of the need to hire for World Cup, which could be one-off. And healthcare, like always, is the one that's constantly adding new jobs. Some comments here: the labor market is looking quite solid, and there's no indication that it needs support. And this is why you see a short-term sell-down in the market and also increase in U.S. Treasury yield, because the Fed will focus more on inflation levels, which also means the likelihood of rate cut will be lower. For wages, it increased 3.4% year-on-year. Not very good. Now it's under both inflation measures now. Both the consumer price and personal consumption expenditure are at 3.8% now and is higher than the wages growth. Unemployment is steady at 4.3%. The layoffs have been moderated, but there are still signs that AI has negative impact on the headcounts in labor. And then for economic growth, it's solid. Quarter 1 annualized came in at 1.6%. Quarter 2 is tracking 3%. That's an estimate so far. So then, because of the strong labor market numbers, it's very likely that interest rate cut will be delayed. But that's also not a bad thing to look at it, since economic growth and labor numbers are quite well supported. On to Section 301 tariffs. The U.S. will apply tariffs up to 12.5% on imports from 60 economies. And these are the economies that are deemed to have failed to ban goods made with forced labor. To name a few: China, European Union, and Japan. And for economies that have adopted a full or partial prohibition on forced labor trade, those economies will face a 10% tariffs. For some background, Section 301 popped up after the U.S. Supreme Court struck down Trump's Liberation Day tariffs. On to Euro area inflation. Eurozone's May inflation is at 3.2% now. Look at the chart at the right. It's quite a bit of a jump. Core inflation is 2.5%. It'll be nicer if the gap were wider. Core inflation excludes food and energy and look into services such as healthcare, housing, insurance, and retail. The core number is also high, which isn't a surprise because of tariffs and now the high oil prices, energy prices too. This adds more motivation for European central banks' preemptive interest rate hike in their upcoming meeting. And looking forward, inflation is expected to increase further. Energy price shock has become more permanent. But the good thing is, oil prices currently is lower than what the majority of people thought it'll be, because many priced in a higher figure for a more adverse scenario. And now the bad thing is, because most European consumers aren't willing to pay more and have been cutting their spendings because high fuel prices suppress their spending power, the corporates aren't confident to pass on their newly incurred input prices to consumers. That'll hurt corporate profits in Euro area. Just a few days ago, Iran and Israel traded strikes first time after the ceasefire in April, and oil prices went up. But it went down after President Trump tried to keep the violence from escalating. Trump also said that the two are looking to agree to a ceasefire, and negotiations are on the way. And then, OPEC agreed to increase targets by 188,000 barrels per day. It's good that there's more supply. But the question is the supply chain, which is the bottleneck, the route from the supply to the rest of the world. This is the critical part that needs to be solved. We've crossed the 100th day mark of the Middle East war, and it's still continuing to drive volatility in the market. And negotiation between US and Iran has stagnated. But then, interestingly, indexes keep going up, especially the S&P 500. Most investors had looked through the war, higher oil prices, and inflation levels, which is why the index is at the new all-time highs. The picture at the right is a summarized roadmap of the war events so far, starting on last day of February to first week of June. This slide highlights the trend looking forward. Optimism over AI's future and the profitable backdrop of US companies are at investors' attention and focus now. So again, they'd looked past the war and the spillover effects. The equity markets are clearly led by companies in US. You can see when the recent S&P 500 earnings did well, the index is quite well supported despite the war, and also the Asian markets that are seen as direct beneficiaries to AI spending, mostly the semiconductor ones. European stocks obviously will be more subdued because they're highly sensitive to the energy costs and are very trade-heavy. Next, spending on AI infrastructure. While there are bottlenecks, meaning the amount needed for CapEx, the land needed to build the infrastructure, and the high power consumption, but because the demand is so strong, it fuels the share prices of semiconductor stocks. So if you see clearly, the markets are led by a small number of stocks. Mostly the AI companies, the direct beneficiaries, and any other companies with strong earnings. These companies will outweigh the weaker ones. Government bonds have been volatile since the war, mostly because of lack of confidence in inflation levels. Just zooming into two, the US and UK, their respective government bonds levels have been quite high. Both are facing sell-off activities. Bond yield move opposite direction to price. When the yield is high, it means there's a lot of selling activities. When price go down, in calculating the returns from the lower entry point, the yield becomes higher. This is basically the relationship. The main reasons for the sell-off are concerns with higher inflation, confidence levels, lower growth in particular countries, and supply chain disruptions. The picture at the right shows the G7 economies and the movements in the respective 10-year government bonds. Although oil prices have fallen from the wartime highs, it'll remain far higher than before the war. The blockade of Strait of Hormuz and the damages and closures of key energy productions will affect the supply chain constraints, which is the route from the oil rigs to the rest of the world. And if oil inventories continue to deplete all the way throughout June this month, there'll be more trouble. Look at the prices at the chart on the right. Brent is the global standard, and WTI is benchmark for US trading. And not just the euro area, but inflation globally is expected to pick up because of the oil problems. Some governments provided support by either cutting taxes on energy or give out some cash support like Japan. The notable ones are Germany, Japan, and India. And simply this problem is causing consumers to spend lesser, which will hurt corporate profits going forward.